Okay, now let's continue our discussion on the IDCO case. So we talk about the first part of this chapter, which is basically about valuation using comparables. So in this case, we compared the acquired firm, IDCO, with other three firms, right? So we compared IDCO with Oakley, Luxottica, and Nike. So the idea here is we basically want to calculate the valuation ratios for IDCO. And then we will compare these valuation ratios with ratios from comparable firms. So if the valuation ratios from IDCO is at least in the range for other comparable firms, then we would know that this acquisition price of $150 million is at least reasonable. And then we also argue that a more rigorous approach here is you would want to think about what kind of improvements you can make to this firm after your acquisition. And then you will calculate the firm's cash flows under these improvements. And then using these forecasted cash flows, you can calculate the firm's value. So the first part of this process is we discussed this business plan here. So we basically started the first part, some operational improvements. These improvements are reflected in this table here. That is, you can see that the firm's market share, right, increases from 10% in 2010 to 15% in 2015. And then we also discussed some capital expenditure. So the assumption here is if the growth in volume exceeds 50%, then IDCO will need to spend some money to undertake a major expansion to increase its manufacturing capability. So we checked numbers and we find out in 2013 the production volume will increase by 50% compared with the volume in 2010. So our result was in 2013 the firm would start expanding its production capacity. Then we made further assumptions. That is, the firm would actually expand its production capability in 2013 and 2014. And to be more specific, we assumed the capital expenditure in 2013 and 2014 would be given by these two numbers. So basically, you can see that this firm will spend at a much larger amount compared with previous years because of the need to expand its production capacity. Okay, now let's talk about some other improvements we can make. Now we talk about working capital management. So first, why do you want to think about working capital management? Well, because if you think about working capital, right? So essentially working capital can be calculated as current asset minus current liability. And if you put more money into working capital, it essentially means you tie more cash into your working capital. So if you wanted to use your cash in a more efficient way, then you would want to manage your working capital in that efficient way. Now, what kind of measures we can think about the efficiency of working capital management? Well, we could use these working capital days. For example, we can look at IDCO's accounts receivable days. So first, if you look at a firm's balance sheet, then you would see that its current asset contains several parts, right? For example, it could have accounts receivable. Receivable. And then you would have inventory, right? And then if you also look at current liability, then the very famous one would be accounts payable. And we know that working capital equals current asset minus current liability. So generally, if you want to manage your working capital in an efficient way, you want to reduce your current asset, and then you want to increase your current liability. By doing this, you will have a smaller working capital, which means you're tying smaller amount of cash in your production process. So here, if you want to reduce your current asset, then you can see that you can actually reduce accounts receivable and inventory. So here we will do both. We will both think about the firm's accounts receivable and the firm's inventory. And here we will measure this firm's accounts receivable days. So what is the formula to calculate this number? Well, you guys have learned about this in your Corporate Finance 1. Now, we are basically just revisiting this calculation here. So accounts receivable days, let's call it ARD, equals accounts receivable, let's call it AR, divided by daily revenue, right? That is your sales divided by number of days, right? So obviously, sales divided by 365 gives you daily sales. And then you can see that this accounts receivable days basically measures, right, how many days this firm can get its money from its customers. And then on the intuitive level, you can see that if you want to use working capital in a more efficient way, you want to reduce the accounts receivable days, right? That basically means you're getting money from your customers faster. So let's see what kind of accounts receivable days this firm Idaco has. Just according to this formula, we need to basically find out this firm's accounts receivable and its sales. So let's see this firm's income statement in 2010. Okay, so let's see the and you can see that we need two numbers, sales, just given by this number, and then also accounts receivable. This would be a number from balance sheet. So so where's the accounts receivable? Oh, it's here. So basically it's it would be 18493 divided by sales divided by 365. So this will give us 90 days, right? And then you would compare this firm's accounts receivable days to the industry average. So let's assume you find out the industry average is just 60 days. And then it basically means that you can make some improvements, right? Sorry, it basically means you can make some improvements. At least you can decrease from 90 days to 60 days. This essentially means you want to tighten IDACO's credit policy to its customers, right? So if you have 90 days of accounts receivable days, it basically means you're extending credit to your buyers for like 90 days. And now you wanted to just extend this credit to your buyers for 60 days. This will reduce your accounts receivable, and this will reduce your working capital needs. Okay, having discussed accounts receivable days, now let's talk about the second component. We have seen that for current asset, we could discuss both accounts receivable, or we could discuss inventory, right? So now let's discuss inventory. And now we will want to look at inventory days. And here to discuss inventory, we will mainly focus on the raw materials. So let's see what kind of numbers do we have. So the firm has $2 million of raw materials. And how do you get this number? So it's given by this additional data. So basically you can see that the total inventories would be 6165. And out of this $6,165,000 of inventories, we have $1,973,000 as raw materials. And then we wanted to use this as the numerator. So inventory days equals 2. And then what is the numerator? Well, if you go back to this Excel, then you can see that there is this total cost of raw materials. So you can see that it's 16,000, I think it's $16 million. So it's $60 million. And then we have 365 days. So essentially the denominator is the daily cost of raw materials. And this numerator gives you the inventory cost of raw materials. So you can see that this inventory days basically means how many days your raw materials will stay in the inventory. So clearly this measures how fast you can turn your raw materials into finished products. And if you want to manage your working capital in an efficient way, you definitely want to reduce this number, right? So you can see that the calculation gives us a number of 45.6 days. And let's assume you would examine the industry average and you find out the industry average is just 30 days, right? So again, you will want to make some improvements. You will want to reduce from 45 days to 30 days. And the third kind of improvement you can make is about the firm's capital structure. So if you look at the firm's balance sheet, what you can observe is the firm has very little debt, right? So you can see that the firm's debt is only $4.5 million. And then the firm's total asset is $86 million. So if you calculate the debt to value ratio, it's extremely small. right? And this basically means you want to lever up, because by levering this firm up, you can have interest tax shield. And this interest tax shield should increase the firm's value. And now we make some further assumption. We would assume the interest rate here is 6.8%. And then we assume the firm will have additional debt in 2013 and 2014. Remember, we discussed in 2013 and 2014, the firm would have additional capital expenditure to expand its production capacity. Okay, now let's look at the firm's interest payment. So we have these 6 years, and then we have these debt levels. And then by given debt, it's very easy for us to calculate the firm's interest payment. So if the debt in 2010 was $100 million, then you can see that the interest payment in 2011 would be $6.8 million. And of course, you could use the same method to calculate interest payments for all other years. Okay, finally, let's talk about PKK's financing. Remember the context here. We discussed you're a partner at PKK, and you want to acquire the firm Idaco. So now we want to talk about the PKK's financing, because as a partner from PKK, even if you want to make the purchase, you have to think about your financing, right? How do you finance your acquisition? So first, let's see what amount of money do you need. So let's say you made an offer of $150 million to purchase Idaco's equity. And then you need $4.5 million to repay Idaco's existing debt. This number basically comes from Idaco's balance sheet from 2020, sorry, from 2010. And now let's assume there is a transaction fee of $5 million. Now you can see that your total expense, or the total amount of money you need for your acquisition, is $159.5 million. Now let's think about your financing. Let's assume, right, you could acquire a bank loan of $100 million. Right? Consider this as a leveraged buyout. You will acquire large amount of debt to make your acquisition. And then let's say your own firm's money would be $53 million. And then let's assume after acquiring this firm, you will get access to Idaco's own excess cash. So if you look at the firm's balance sheet, the firm's excess cash is $6.5 million. So now you can see that how your financing will work. So to finance this amount, you will use $100 million of bank loan, and then you will use Idaco's own excess cash and your own money. So it's your own equity investment. Okay. Now, let's think about financial modeling here. So why do you want to do this? Well, the reason is because your goal is to value your investment. So after making some improvements, right, such as more efficient working capital management and better capturing the interest tax shield, you will want to think about the firm's future cash flows. Because in the end, if you want to value this firm, you have to at least know the firm's future cash flows. So now you will use this financial model to forecast, to project the firm's future cash flows. Okay. So first, you will build this pro forma income statement. And this type of income statement basically means it's a fictional, or it's a income statement which gives you anticipated numbers after a certain transaction. So it's really about forecasting the future. So let's see how can we get this pro forma income statement. Clearly, if you want to build a income statement, the first step is you want to look at the top line, right? What is the sales number? Now, how can we get the firm's sales? Well, this is actually pretty simple, right? If you look at the Excel file, we have made some assumptions about the operational improvement. We have assumed the market size would be 5% increase per year. And then we also assumed the market share will increase by 1% per year. And the average sales price will increase by 2%. So you can clearly get your sales number from this assumption, right? Because if you use the total market size times market share, then you will get your firm's number of units, right? Or how many products you can sell. And then if you further multiply this number, average sales price, then this will give you your annual sales number, right? So you can see that sales equals market size times market share times average sales price. And then you will, to build your income statement, the second step you want to think about is COGS, right? The cost of goods sold. In this case, you will want to calculate your material cost. And if we consult this Excel file, you can see that raw material is measured based on per unit, right? So basically you can see that you could just use the number here. Let's say if you want to calculate the raw material costs in 2010, you would just use 16%, sorry, you could just use $16 times number of units. Now, how do you get number of units? Well, we have discussed this. You could just basically use market size times market share. This gives you the number of units. So here you can see that raw material costs equals the material costs per unit times market size times market share. And then you have to think about sales, marketing, and administrative cost. So if you look at the table here, then you will see that it is based on the percentage of sales. So you will just use the sales number times the percentage given, right? So you can see that it's sales times the percentage. And you will also think about corporate tax, which is pretty easy. That is income tax equals pre-tax income times tax rate. Okay, so you can see that based on our assumptions, right, we can now find out all the data points we need to calculate the firm's income statement. And you can see that, as a good practice, you could actually, so when you're at home, right, you can check these numbers and see how you can solve these numbers. Okay, so now you can see that given these projected numbers, these projected sales numbers and these projected COGS number, we can get our gross profit, and then we can get our projected SG&A. So this will give us EBITDA, right? And then after depreciation, we get EBIT. And then we will deduct interest expense. This gives us the taxable pre-tax income. And minus income tax, this gives us net income. So you can see that this modeling process was actually quite straightforward, right? The basic process here is you have to make some assumption about how the firm's future will look like. And based on these assumed futures, you will think about how to get numbers on the firm's sales, right? How to project, how to anticipate future sales, future costs of goods sold, and then based on these forecasted numbers, you can forecast net income. Clearly, this is a process which requires experiences. But now, at least you get this methodology, right? What is the basic process of doing this? Okay, now let's see this example here. By what percentage is IDECO's EBITDA expected to grow over the 5-year period? By how much would it grow if IDECO's market share remained at 10%? So first, we're asked to calculate the growth rate, the 5-year growth rate for IDECO's EBITDA. And you can see that this is a pretty simple question, because here we have this pro forma income statement. Then you could read EBITDA directly. So you can see that in the beginning, then the number was 16250. And then what happened? And then the number increases to 32094. Oops. 32904. Okay, now you can see that the increase is given by this really simple calculation. So this gives us, I'll just copy this. So it's 1.97. And if we're looking at this growth rate, then it should be 1.97 minus 1, which is 97%. Oh, sorry. The number here should be just 97%. Okay, now the second question. By how much would the EBITDA grow if IDECO's market share remained at 10%? So remember the assumption, right? The assumption for this pro forma income statement is we assumed the firm's market share would increase from 10% to 15%, right? Just check the Excel file. Right? So we used this assumption here. Initially, the market share was only 10%, and then it increased to 15%. Now you're asked to calculate the firm's EBITDA under this alternative assumption. That is, the firm's market share remained at 10%. Right? So let's check this table here. So we know that initially, the firm's sales number was this. And then under the assumption the firm's market share will increase to 15%, we get a number like this. But now let's think about the alternative assumption. That is, the firm's market share always stays at 10%. So you can imagine that if we assume the firm's market share stayed at 10%, then the sales number in 2015 should be 10% divided by 15% times, let me write it here. So under this alternative assumption, the sales number into 2015 should be this number, right? And then if you think about the raw materials and direct labor cost, you can see that it should be the same. That is, you will still scale this number with 10% divided by 15%. Okay, divided by 15%. And then the raw materials is given by 32,193. So it's 32,193. Okay, now this direct labor cost obviously should be the same, right? So 10% divided by 15% times this number. And then you can verify that for other numbers, you will also do the same, right? So in the end, the EBITDA would be equal to 10% divided by 15% times 32094. And then you will get a number of, so the number should be, it should be 2140, right? So this will give you 21.40. And in terms of growth rate, it would be 21.4 divided by 16.25 minus 1, which would be 32%. Okay, so you can see that for this second one, right? For the second question, it looks complicated. But what you really need to understand is this sort of scale factor here, right? How do you get this number to rescale this original calculation? And you can also, but by the way, if you want to think in details, why should you use 10% divided by 15%? All you need is this Excel file, right? You will actually think about, you will actually look at this table here. You can see that if you calculate the sales, right? Let's see how you calculate sales. So if you want to calculate sales, then you can see that you will use market size times market share times average sales price. And then you can see that if in 2015, right, your sales would be given by 12763 times 15% times 82.81. And now under this alternative assumption, if there is no growth in market share, then the new calculation would be 12763 times 10% times 82.81, right? So basically you can see that the difference between these two numbers are just 15% and 10%. right? So that's why here you wanted to use 10% divided by 15%. And you can check with other numbers, right? This raw materials, labor costs, you can check with these other numbers, and you can see that this kind of methodology, this kind of shortcut here will actually be correct. Okay. Now, let's think about the firm's working capital requirements. So, if you look at what we're doing here, we're actually just thinking about how to get cash flows, because to get cash flow, you will first get the firm's net income, and we have achieved this. And then you will have to look at the firm's net working capital, right? So to do this, you will again make some forecasts, and you want to forecast what are the firm's future working capital needs. And in the prior section, we discussed our business plans. And in those business plans, we discussed we could make some improvements in the firm's working capital management, right? So here, we will forecast the firm's future working capital needs based on those improvements. Okay, now let's see what kind of improvements we're having here. So originally, we have these working capital days. And you can see that we have different kinds of calculation here. So we have 4 different types of days for the current assets. And then we have 2 kinds of days for the current liability. And what you can see here is we're making improvements in both accounts receivable days and inventory days, right? Because we discussed this before. That is, if you can reduce the days, then you're using your or you're managing your working capital in a more efficient way. So now we have to forecast our future working capitals based on these days, 60 and 30, right? So what we're gonna do is to forecast accounts receivables in the future, we will use the days required. Remember that we have the number 60, right? So we have the number 60. And then we will use annual sales. And then we will divide this annual sales by the number of days. So this will give us a forecast of future accounts receivables. So this is pretty simple, right? Because we have learned accounts receivable days equals accounts receivable divided by, let's call this daily sales. In this case, we're assuming that you have the accounts receivable and you have daily sales, and you want to calculate accounts receivable days. But we could also do something else, right? So we could also calculate accounts receivable, which is equal to accounts receivable days times daily sales. And this number is given because we wanted to improve this firm's working capital management. So we wanted to maintain a 60-day accounts receivable, right? And times daily sales. Well, we clearly can find out daily sales, right? Because we just did the pro forma income statement, right? We have these sales numbers and use these sales numbers, and we divide these sales numbers by 365 days, we can get daily sales, right? So for example, you want to forecast the accounts receivable in 2011. What you're gonna do is you will use 60, right? And you will use the annual sales forecast in 2011. And you can double check the number is $88.358 million, right? And you can see that this is the exact number we're using here. And then divided by number of days per year, right? You will have daily sales. And then this $14.525 million would be our forecasted accounts receivable in 2011. So based on this approach, we can basically forecast accounts receivable, raw materials, wage payable, and other accounts payable. For example, if you want to get this, okay, let's look at this number. Let's say if you want to get this number. Now, basically this number equals inventory days times cost of, or I should say more accurately, annual cost of materials, right? Divided by the number of days in 1 year. And if you plug in numbers, so again, what is the inventory days? 30 days, right? So if you have 30 here, oops, if you have sorry, my app stops responding. Okay, so we have 30 times the annual cost of raw materials, and we will still have to look at the pro forma income statement. So we have 18.665. So 18.665 divided by 365. So this will give us, I believe it should be $1.534 million. So which is exact this number here, because this number is in units of thousand. Okay, so basically you can see that we can basically forecast all the numbers for the current assets and all the numbers for the current liabilities. And then we can calculate the firm's net working capital, which is calculated as the difference between the current assets and the firm's current liabilities. So this row gives us net working capital. And then next, we will want to look at the change in net working capital. This is easy, right? Because you can see that this number 3412 is given by the net working capital in 2011 minus the net working capital in 2010. Oops. Okay, now we can finally think about forecasting the firm's free cash flow. We have learned the formula of calculating free cash flow, right? We know that free cash flow would be equal to unlevered net income plus the depreciation minus the increase in net working capital and minus capex. And this will give us the free cash flow of the firm. And then if we want, we could also adjust from the free cash flow of the firm to the free cash flow to equity holders. So here you can see that if we start with free cash flow of the firm, then we would plus net borrowing, and then we would minus the after-tax interest expense. So this will give us the free cash flow to equity. Here we are just talking about some accounting equations, and since most of you guys are from accounting department, I would say this is quite easy for you guys. You can also see that we're actually, in this case, we're going from net income to unlevered net income. So essentially what we are doing here is we use net income plus after-tax interest expense. So this will give us unlevered net income. Okay. So, I mean, to understand this is actually pretty simple, because if you look at net income, right? So net income essentially equals EBIT minus interest expense times one minus corporate tax rate. And then if you continue to do this simple manipulation here, you can see that it's 1 minus tau C minus this, right? And then you can see that net income plus the after-tax interest expense, right? If you plus the net income, if you plus the after-tax interest expense, you can see that these two terms will just cancel out. So this leaves us with this. And EBIT times 1 minus corporate tax is exactly the definition of unlevered net income, right? So you can calculate unlevered net income as the sum of net income and after-tax interest expense. Okay, now let's see this example here. Suppose Idaho does not have leverage in 2013 and 2014, but instead keeps its debt fixed at $100 million until 2015. How will this change in its leverage policy affect its expected free cash flow? This is the first question. The second one is, how will it affect the free cash flow to equity? So first, we're thinking about the firm's free cash flow, right? That is, we are thinking about this number here. Now, if you look at the assumption here, now we assume the firm does not add leverage in 2013 and 2014. Now, if you look at these numbers, you can see that net income, if you look at these numbers, you can see that unlevered net income will not be affected by the firm's leverage policy, right? Because unlevered net income is calculated as EBIT times 1 minus corporate tax rate. And EBIT is essentially the firm's earnings from its business operations, right? It is not affected by how the firm finances its business operations. It is not affected by the firm's capital structure. This basically means unlevered net income should stay the same. no matter what kind of leverage policy IDCO is using. So these numbers should not change. And then you can see that depreciation, net working capital, and capex, these numbers will not be affected by your leverage. So here you can see that the free cash flow of the firm should stay the same. Right? So the answer to the first question is the firm's expected free cash flow would stay the same. And now let's think about free cash flow to equity. Clearly you can see that this number has to change, right? Because we will adjust from free cash flow of firm, which stays the same. However, net borrowing and interest expense will change because both of these two numbers are related to the firm's leverage policy. So what I can see here is under this alternative leverage policy, we can see that net borrowing will be zero in 2013 and 2014 because we have assumed the firm would not have additional borrowing in these 2 years. And then what happens is because we don't have additional borrowings, the firm's interest expense should be the same as prior years. So here we will get 4420 and 4420. So basically you can see that the firm's free cash flow to equity should stay the same for the first 2 years. And then for year 2013, 2014, and 2015, the free cash flow to equity should change, right? So the answer is given by the lecture note, and you can see that we have some different numbers for for 2013, 24, okay, I apologize. The app is really buggy. I don't know why. Okay, so we have these three numbers which would change under this alternative leverage policy. Okay, now we basically have finished the first step of valuation, that is finding out cash flows. Now we have to think about the discount factor for those cash flows. So here we will basically start estimating the firm's cost of capital. So remember that we discussed where we assumed the firm IDCO is a private firm. So again, we will use this comparable firm analysis. We will basically look at the cost of capital from other comparable firms, and we will borrow this number from comparable firms. Remember in the last chapter, right? The approach is we will look at comparable firms' unlevered cost of capital, right? And then we will use this unlevered cost of capital as our own firm's unlevered cost of capital. So this is just one way of estimating the cost of capital. Alternatively, we could also look at a comparable firm's unlevered beta, and then we could borrow those comparable firms' unlevered beta as our own firm's unlevered beta. You can imagine that these two approaches are essentially the same because according to capital asset pricing model, if you give me unlevered beta, I can give you unlevered cost of capital. And if you give me unlevered cost of capital, I can give you the unlevered beta. So they're really the same idea here, just slightly different approach. So basically we will first, right, estimate the equity beta for comparable firms. Recall that we have three comparable firms: Oakley, Luxottica, and Nike. And based on these comparable firms' equity beta, debt beta, and their debt value ratio, we can calculate these comparable firms' unlevered beta. And then we will use the unlevered betas of the comparable firms to estimate our firm, IDACO's unlevered beta. And then, after getting the firm IDACO's unlevered beta, we will estimate its equity cost of capital and its WACC. And then we will be able to value those cash flows we just obtained. Okay, so first, let's say you're given this table. So let's say you have estimated for these comparable firms, they have their equity cost like this. And you assume they have a debt beta of 0. And you can also figure out what are their equity value ratio and debt value ratio. So clearly, after getting these numbers, you will be able to figure out these firms' unlevered beta, right? Because the formula for calculating unlevered beta is the equity value ratio times the beta of equity plus debt value ratio times the debt beta. For example, if you want to calculate Nike's unlevered beta, then it should be 1.05 times 0.6 plus minus 0.5 times 0. So Nike's unlevered beta equals 0.63. So now, using this method, you can have 3 numbers. And you can see that even supposedly these 3 firms are comparable to IDACO, their unlevered betas are actually quite different, right? The lowest one, Luxottica, has a unlevered beta of 0.62. And the highest one, Oakley, has a unlevered beta of 1.5. So there is huge difference. Now, as the financial modeler, you will want to ask, so which number should I use, right? Should I just use the average of these 3 numbers? Or should I dig deeper and think about the firm's businesses? Well, if you follow the textbook, it uses the second approach. That is, you will dig deeper and think about comparable firms' businesses and IDACO's business. And you will look the similarities and the differences between comparable firms' businesses and IDACO's business. And then you will adjust your estimation of beta for IDACO accordingly. So let's see the story here. So the claim here is IDACO's unlevered beta is likely to be closer to Oakley's compared with Nike and Luxottica. This kind of claim is really based on these firms' business operations. The argument is IDACO does not have a prescription eyewear division as Luxottica. So you would think IDACO is not that similar to Luxottica. And then you would think IDACO's products are fashion items. They are not exercise items. In this sense, this implies IDACO's business is not that similar to Nike's. So basically, you can see that under these 2 arguments, you could say that maybe IDACO is more similar to Oakley's. And then you will compare IDACO's products with Oakley's products. And then you find out IDECO's products are not as high-end as Oakley's. So this implies that IDECO's business should have smaller beta compared with Oakley's business. So what's the intuition here? Generally, if your business is if the products from your business are more higher end, then the beta of your business will be larger. The reason is because if your products are at a higher end, then these are really not necessities. So the demand for your products will actually change according to the business cycle. That is, the cash flow to your firm will be more volatile if the products are at a higher end. You could also think about the opposite, right? Let's say you're selling groceries, and groceries are necessities. Then you can imagine that your business will not be so volatile because no matter whether the economy is bad or good, people will have to buy groceries. So the cash flow to your grocery stores will be quite smooth. So the beta of your business should be actually smaller, right? So to summarize, your argument is IDECO's business is not so similar to Luxottica and Nike. And IDECO's business is more similar to Oakley's. However, IDECO's products are not as higher end as Oakley's. So this implies its beta should be closer to Oakley's, but not as high as Oakley's beta. And you can see that you will use 1.2 as your estimate for IDECO's unlevered beta. And you can see that this number is actually reasonable because Oakley has a unlevered beta of 1.5, and you want your beta to be closer to Oakley, but you don't want the beta to be as high as 1.5, so you will use a number of 1.2. Of course, you could use other numbers. You could use 1.21 or 1.25. Okay. Now, after getting this unlevered beta for IDECO, we can calculate IDECO's unlevered cost of capital. So let's assume the risk-free rate is 4%. And let's also assume the expected return of the market is 9%. So given these numbers, right, you can calculate the unlevered cost of capital for IDECO is 10%. Okay, let's see this example here. So use the following tables, right? We have two tables here. What range of unlevered cost of capital estimates is possible? This is a pretty simple question. So what you can see here is Oakley has the highest beta. And then the other two firms, they have lower betas. So what we will do is we will calculate these firms' unlevered cost of capital under these, So we will calculate these three firms' unlevered cost of capital, right? And then we will see what kind of range do we have here. For example, for Oakley, its unlevered beta is given by 1.99 times times 1, which is 1.99, right? So doing the same for the second firm, we should use 0.56 times 0.83. Oh, you also have these numbers here. Just ignore them. So this give us, let me see. This will give us a certain number. And then for Nike, it should be 0.48 times 1.05. Let me see what kind of numbers do we have here. So for Luxottica, we have 0.46. And then for this, I don't know, I guess we will get something like 0.5. And now you can see that the range of the unlevered beta is 0.46 to 1.99. So this implies the estimation of the unlevered cost of capital to be given by 4% risk-free rate plus beta times 5% market risk premium. And then on the right-hand side, we get 4% plus 1.99 times 5% market risk premium. So this will give us a range of 6.3% to 13.95%. Okay, now let's talk about valuation. So first, we will estimate IDECO's value at the end of the 5-year investment horizon. So in this case, we will basically estimate the firm's terminal value. And we will use two approaches, a multiple approach and the WACC approach. So here we use the multiple approach. It basically means you will use the firm's valuation ratios to estimate the firm's terminal value after 5 years. WACC approach, well, that's easy. It's just a WACC method. And then after getting the firm's terminal values after 5 years, we will, using the estimation of the firm's free cash flow, then we will be able to calculate the firm's value using APV method. Okay, I guess now it's confusing. What we would do is this. So let me use the timeline here. Timeline is always helpful. So let's say as a investor, after acquire this firm, you will actually keep this firm for 5 years. And at the end of 2015, you will want to sell this firm. So you will want to estimate a terminal value at the end of your investment period. So you will calculate V2015, right? That is the firm's terminal value at 2015. Now, how do you calculate this? Well, you will use two approaches. So you will use a multiple or valuation multiple approach. You will use valuation multiples. And you will also use WACC method. But your goal is, right? Your goal is you want to understand the firm's value here, right? What is the initial value in 2010? To do this, you will look at the firm's cash flows, right? So you will look at the firm's cash flow at each period. And you will use these cash flow with this terminal value in 2015 to calculate the firm's value in 2010. And how do you calculate this? Well, you will use the adjusted present value method. And we also mentioned, in addition to use a okay, let me fix this app. Okay, so we also want to mention that in addition to NPV, we will also look at the internal rate of return and the cash multiples as the evaluation tool to value this acquisition. Okay, now let's think about the multiples approach to continue to calculate the firm's value in 2015. So here we will use the firm's EBITDA multiple, because when you're using the valuation multiple to value a firm, you could have so many valuation ratios to use. So here, following the textbook, we use the EBITDA multiple. And what you can see here is the formula which tells you how to do the valuation here. So you can see that we call this number as continuation enterprise value at forecast horizon, which is not intuitive at all. It's really the firm's value in 2015. Okay? And it equals EBITDA at horizon. It's just EBITDA in 2015 times EBITDA multiple at horizon, which is just, well, you guessed it, EBITDA multiple at 2015. So we basically have to find out two numbers, right? What is the firm's EBITDA in 2015 and what is the firm's EBITDA multiple in 2015? So we assume EBITDA multiple is the same from the value of 9.1 when we calculate it at the time of the original purchase. If you recall what we have done in the first section of this chapter, we did calculate IDCO's financial ratios, and we got this number, 9.1, right? So this is a number in 2010, and now you would assume the firm will have the same EBITDA multiple after 5 years. So you assume EBITDA multiple in 2015 would be the same, would be the same 9.1. Now, how do you get EBITDA at 2015? Well, we have done this before, right? Because we have this. So let me, you know what? Let me use the Excel file. Because we have this, pro forma income statement, and we know that we have forecasted the firm's EBITDA. And in 2015, the number is $32 million, right? So it's 32094. So that's the number we want here. So it's 32094. And clearly you can see that the terminal value estimation in 2015 would be given by the multiplication of these two numbers, right? So if you look at this table here, that is exactly what this table is trying to do, right? EBITDA in 2015 times this multiple, which give us a continuation enterprise value. Oh boy, that's not a good name. So which give us the value in 2015, and the value is about $292 million. And then minus the amount of debt, we can find out the firm's equity value at 2015, right? So it's given by this number. Now, how do you get this debt? Well, again, we discussed this. The debt is given by the problem. We know that the firm will have this outstanding debt in each year, and we know that at 2015, the level of debt would be $122 million. Okay, so you can see that very simply, right? By assuming EBITDA in the future and EBITDA multiple in the future, we can estimate the firm's enterprise value in the future. And then by forecasting the level of debt the firm will use in the future, we can calculate the value of equity in the future. And then after calculating this number, after calculating the firm's value in 2015 and the firm's equity's value in 2015, we can actually double check whether these two values make sense. To double check, we will again use valuation ratios. For example, we can actually we can actually calculate the ratio of enterprise value and sales. So let's do the calculation here. So EV versus sales equals 292052 divided by sales. How do you get sales? Again, use our pro forma income statement. So you can see that sales is given by 158,526. So 158,526. And you can verify that you should get a number close to 1.8. And then we could also talk about PE ratio, right? So PE ratio, it should be about the firm's net income divided by, it should be the firm's equity divided by its net income. So what is the net income in 2015? It's 10545. It's 10545, right? So this gives us 16.3. And then you could also calculate the unlevered PE ratio. Unlevered PE ratio is just the firm's enterprise value divided by its unlevered net income. And again, you can get these two numbers from that pro forma income statement. Now, why do you want to get these valuation ratios? Well, as I said, you want to see whether these two numbers make sense, right? Remember that these value ratios are calculated using these two numbers. So if these valuation ratios make sense, then it will basically tell you that your results, that is, these estimated numbers, at least they're reasonable estimates, right? So if you compare these valuation ratios with comparable firms, you can see that the EV sales ratio is 1.8. And if you look at comparable firms, EV sales ratio is 2.7, and 1.5. So you can see that the 1.8 EV sales ratio is reasonable, right? You could also say, you could also check the PE ratio. So the PE ratio is 16.3. And you can see that here, the PE ratio for comparable firms, it ranges from 18.2 to 28. So again, you can see that the PE ratio of 16.3 is reasonable. So this basically gives you some confidence that your estimated numbers, these two numbers, they're reasonable estimates, right? Okay. Next, I guess I will stop here because we have finished this multiples approach. So in next class, we will talk about using discounted cash flow approach to calculate these values in 2015.